In this webinar, I'm going to be walking you through how you will do a valuation for your business. If you're a small business owner and you're thinking about selling your business, this is something that you are going to want to do. This is how you will go about doing it. Circumstances under which you will need a business valuation is if you're curious as to how much your business is worth, you can work with your accountant to determine that. That would be a great starting point. They can help you run some preliminary numbers. You can get a formal business valuation done where you can pay for that service. They range based on the size of the business and how detailed of an evaluation you want. If you want a certified appraisal, that's different from a business valuation that, let's say, a business broker can also help you with a valuation. Most of them do valuations for free. I am a business broker and do offer that service, but I also offer to do a valuation you pay for and it's yours to keep, and you don't have to work with me. You would have that valuation. So with all of that being said, let's talk about the process. The first thing that you will need to do when you're ready to do evaluation of your business is gather all your financials. We'll need 3 years of profit and loss statements. We will need 3 years of tax returns. It's not on this slide, but I like to see tax returns and profit and loss statements because there can be differences between them. And I want to make sure that it's ideal that the profit and loss is as close to the tax return as possible. Then we'll need a current balance sheet. The current balance sheet will help us to understand the company's assets, liabilities, and equity, and it provides insight into the financial position of the business. When we go through these statements, we'll be looking to identify trends. We'll be assessing the financial health of the business and determining how to adjust the financials. Now, what do I mean by adjust the financials? There are, let's say this is your profit and loss or your tax returns. You have your revenue, your sales, then you have your cost of goods sold, and then you have your expenses. Now, in those expenses, there will typically be things that you, the owner, expense that a new owner may not need to have within the business. So those could be owner salaries. We identify and remove any salaries or compensation paid to the business owner or family members. Sometimes people have family members on the payroll and they don't necessarily have a full-time position. So those can be removed. Another example would be personal vehicles, the maintenance or the fuel on those as well. Sometimes they are expensed or run through the business, but it's not a true business expense. We have non-operational expenses. We would remove any expenses that are not related to the day-to-day operations, such as personal travel, entertainment, and donations. So you get the general idea. And I'm sure if you've been running your business for 20 years or 10 years, you know right off the top of your head what expenses would actually be considered an adjustment and then be added back to the business. That cash flow would be added back to the business so that the profitability would be higher. So we also have something called non-cash expenses, and these would be added back in. You can talk with your accountant about those. We have depreciation, we have amortization as an example, and then identifying and understanding non-cash expenses are crucial for reporting, and a professional can help you with that. Again, if you're doing this on your own just to get a general idea, chat with your accountant, but a good business broker will be able to help you with that also. The next step that we have to do is determine what's called seller's discretionary earnings, SDE. And this again is a term that's not very familiar to small business owners. I previously ran a small business. I ran an engineering company with about 50 employees and 50 subcontractors. These just weren't words in my world. So that's why I thought it would be helpful to share this with you in a simple, broken down way. So what is seller's discretionary earnings? You'll see over here, owner's compensation. This is an example of something that we would be adding back and would become part of the SDE. We add back the owner's salary, bonuses, and any other compensation that is not essential to the business operations. We're trying to get to the term SDE as owner benefit, adding back everything that has been a benefit to you as the owner, that a new owner won't necessarily want to benefit from when they own the business. We have one-time or non-recurring expenses, so we would identify those, such as legal fees, consulting fees, or an equipment purchase. Personal expenses would be added back to the business. These would be things such as automobiles, travel expenses, or entertainment. Just a side note here, you're going to want to be very careful and make sure that you can verify these add backs. I've seen in the past, I've worked with business owners that they have a lot of revenue, a lot of expenses, and a lot of add backs, but it's all just kind of like put onto a profit and loss, it's put onto a tax return. That's fine. Their taxes are, next to zero that they pay the government, but we can't actually verify any of these add backs. And where that's going to become a problem is with a buyer, they're not going to accept those add backs. And with a lender, a buyer is going to want to get financing, and they have to be able to show the lender that the valuation that the seller is claiming is true. And how they do that is by being able to prove these add backs. And I have a little note here that I wanted to share with you, because I have a checklist from a lender. Lenders want to see all of these things, but they have some additional things. And my line item here is add backs verification. Ensure all add backs are fully verified and documented. This is the information that, as I'm helping you get ready to do a valuation to get the value of your business so you can list it for sale, Mr. Banker is going to hand the buyer a list like this and say, go get me all these things. And then Mr. Buyer is going to come to Mr. Seller and say, I need all these things. One of these things is going to be verification of add backs. So you have to be ready with that. So you can't just stick a bunch of stuff in there that you can't actually prove should be added back. The next determining factor is your inventory considerations. We need to determine the current inventory value. If you understand that inventory can change, it gets adjusted up or down through the process of selling your business, assess the current value of the inventory, including any raw material, in the asking price. I like to determine the value of the business and then include the inventory, but the inventory amount is adjusted up or down at the time of purchase, because you could have inventory that you begin selling and your business is under contract and suddenly it gets busier. The buyer, at the time they make the offer to the time when they actually close on the business, the inventory amounts could be different, and that should be adjusted. Factor in inventory adjustments, adjust the asking price based on any changes in inventory value such as spoilage, obsolescence, or fluctuations in market prices when you're determining the value of the inventory. And it's going to be at cost. You're not going to be listing that at retail price. Ensure inventory is accurately represented. Thoroughly document the inventory and its condition to ensure the buyer has a clear understanding of what is included in the sale. By carefully considering the inventory and its value, you can accurately price the business and provide transparency to the buyer, leading to a smoother transaction. You don't want to have sticky problems with inventory when you're going through due diligence. So better to deal with that at the time that you're doing the valuation. Okay, so we have all of the information about the business. We have the financials. We have, all of the trends analyzed, and now we are going to be applying the multiple of SDE. This is another term that you probably won't have heard of, SDE Multiple. We're going to look at industry analysis. A good business broker can help with that. None of this is a plug. I just wanted this to be educational. We evaluate the industry's growth potential, market share, and competitive landscape to determine an appropriate SDE multiple. Simple terms, a business is going to be valued on a multiple of the profit. We're trying to make sure that the profit is as healthy as possible so that when you do the multiple, you get the correct valuation for the business, the correct asking price, and the correct sale price. We assess current and projected market trends such as consumer demand, technology advancements, and regulatory changes to inform the SDE multiple. Consider the company's competitive position within the industry, including its market share, pricing power, and unique value proposition. Evaluate the company's growth trajectory, expansion plans, and ability to capitalize on market opportunities to determine an appropriate SDE multiple. Okay, so a few comments on this. When we say growth potential, you don't want to look at this and say, well, if somebody put $100,000 into my business, they could do XYZ with social media and this business would explode. That's not what we're talking about. It has to be actual genuine growth potential that you see. Maybe there are products that you could add on. There's some cross-selling that you could do that you just haven't done because you're comfortable with the business the way that it is and you've been operating for 20 years and it's given you a good lifestyle. That's what we're talking about. Competitive position. Many times business owners will say, I don't have any competition. I mean, that's just not true. So be open-minded and be logical. Kind of look at it through the buyer's lens, what they would want to see. Okay, so by applying an SDE multiple that considers industry, market trends, competition, and growth potential, you can arrive at a valuation that accurately reflects the company's true worth and future prospects. So we have the intangible assets. These will be based on what you know. So, you'll have to be the one that really gives this opinion, but we don't know if a buyer is going to agree with you or not. So just keep that in mind. We have goodwill valuation. Assess the goodwill, which represents the premium paid for a business over its net tangible assets. Customer relationships. Evaluate the value of customer relationships. If you have contracts, great. It can be a negative because you could have contracts or you could have high customer concentration. That would be bad. We have brand value, determine the value of your brand. And these are all things that don't swing the pendulum hugely, but do make a difference to nudge up the value because we are looking at a multiple of the seller's discretionary earning, and so these will edge that multiple up and therefore get you a higher value for your business. So then we have to look at market position, competitive analysis, industry trends, pricing comparison, customer feedback. These are all things that you could do if you were just doing this in-house and you wanted to work with your accountant and just get a rough idea, a range. You could certainly do a SWOT analysis. That wouldn't be a bad idea because that will help you figure out all of these things. And if you haven't raised your prices in a few years, you might have some more gas in the tank where you've got 5 more years, that you could really push down and grow the business a little bit. This could be a good exercise for that as well, not just valuing your business. We have some comprehensive valuation factors. So we have to evaluate all the relevant assets, liabilities, inventory. We need to establish a thorough and accurate picture for the valuation process. So we have fixed assets, current assets, intangible assets, liabilities. We need to look at all of these as we determine the value. Analyze economic indicators, access industry trends, consider competitor positioning, incorporate customer insights, adjust for risks and uncertainties. So I'll give you some examples. Customer insights. If somebody wants to buy your business, they may want to either speak to some customers or see some customer testimonials. I was just involved with a business deal where the business owner had over 1,000 positive customer testimonials. So that obviously had a positive effect on the valuation. You have to adjust for risks and uncertainties. Are there any pending lawsuits? Is everything in line with the payroll? Have people been categorized properly as W-2 employees versus 1099s? That's always one that makes me. Small business is typically going to be an asset sale. So it does get de-risked for the buyer because they're not buying the stock of the company, they're buying the asset. So that's just something to bear in mind. We want to examine the trends. I've worked on some businesses in the funeral space, and there are some big industry trends going on there because their cost of service is going down because cremations are on the rise. So if somebody has a traditional funeral home and they've got all this overhead to service that traditional service, and yet the services have changed and the margins are slimmer, that's something that has to be analysed. That's just an example for you. If you would like more information about having a valuation done, feel free to reach out to me. Let me know if you need any help.